Hello and welcome to the Baird Trust Large Cap Equity Second Quarter Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. Jumping right into performance, the table at the top of this slide shows our performance track record. In the quarter, our portfolio declined 15.5% gross of fees and 15.8% net of fees compared to the 16.1% decline for the S&P 500. And then for the first 6 months of the year, our portfolio declined 21.1% gross and 21.6% net, compared to a 20% decline for the S&P 500. Our slight outperformance in Q2 was driven by one key factor. The worst performing sector in the S&P 500 was the consumer discretionary sector, with a 26% decline in the quarter. Fortunately, the four companies we own in this sector, CarMax, Home Depot, O'Reilly Automotive, and TJX, only saw stock price declines of between 6 and 8%. In addition to this, we had a few large holdings like Progressive and Johnson & Johnson that actually saw their stock prices increase in the quarter. And on the flip side, some other large holdings like Apple and Berkshire Hathaway that declined more than the broader market. And then for the year-to-date period, our underperformance versus the S&P 500 was driven by a few factors. First, we own no energy companies. The energy sector was by far the best performing sector in the S&P 500 and the only sector with positive performance for the year, rising an astounding 32% year to date. Commodity-based industries like energy do not fit our investment process because their cash flows are entirely predicated on the booms and busts of a volatile and unpredictable commodity. Additionally, we have no holdings in the utilities or consumer staples sectors, which were the next two best performing areas of the market. Utilities are heavily regulated businesses that don't generate exceptional performance over full market cycles. And then on consumer staples, we actually looked closely at a handful of these companies about a year ago, but felt that their high valuations and low growth rates weren't attractive at the time. Our having no holdings in these three sectors negatively impacted our relative investment performance by nearly 3 percentage points. Finally, looking at year-to-date individual company performance, we did have a few bright spots, Progressive and Johnson & Johnson with positive returns, but on the whole, most stock prices fell, with some of our largest positions like Home Depot and Microsoft experiencing steeper declines than the S&P 500. As we always say, stock prices are way more volatile than the underlying performance of each individual business. In 2021, we saw stellar stock price performance that outpaced business performance for the most part. And now we're seeing the reverse effect where stock prices are doing much worse than the underlying business performance. And this is why our focus remains squarely on our long-term investment returns rather than the ups and downs over any given quarter or 6-month period. Over very long time periods, 5, 10, 20 years, a company's stock price will more accurately reflect the success or failure of its underlying business. Moving on, this slide shows our recent portfolio changes. While we have not made any changes to the portfolio so far in 2022, our research efforts remain highly active. We continue to investigate new companies that might meet our investment criteria and are adding to our library of knowledge daily. We believe our current portfolio is filled with wonderful businesses, so the bar for a new investment is high. But we do stand ready to act when we find an opportunity that meets our investment criteria. This slide shows our current sector weightings as well as our top 10 holdings at the end of the quarter. And here I'll just emphasize that we are bottom-up investors. This means that we look for businesses and management teams that meet our investment criteria regardless of sector. We never make any decisions based on any sort of macroeconomic or top-down sector exposure. And because of this, our sector weights often look much different than those of the S&P 500. And finally, just a few big picture comments. Stocks were volatile in the quarter, with price declines accelerating from the first 3 months of the year, pushing the S&P 500 and other major indices into a bear market. Unfortunately, we don't know the duration or the severity of this market decline, and we don't believe that it's knowable or predictable. We may have already seen the worst of it, or there may be another major leg down. Short-term market fluctuations are not controllable, so we focus on what we can control, which is our investment process. One of the hallmarks of this process is that we prepare for downturns before they happen by focusing on very high-quality businesses with competitive advantages, low levels of debt, and excellent management teams. Now, these characteristics don't insulate these stocks from short-term price declines. However, businesses with these characteristics often grow stronger during economic slowdowns and market corrections. They can be offensive in an uncertain environment like today, and they often emerge from the contraction more competitively advantaged than when they entered. We know seeing stock prices and account values decline is unnerving. It is not a pleasant experience, but the best course of action is to try to set emotions to the side and stick to your well-crafted investment plan. Fortunately, bear markets don't last forever, and every bear market in history has ultimately been followed by a bull market, resulting in new all-time highs. So that does it for the Q2 portfolio recap. We look forward to reporting our Q3 results to you in October. Thank you so much for your time.